Hello, welcome back. We're going to talk about Snowflake, which just reported earnings and they are down about 13.3% in the after hours market. We'll see what's going to happen tomorrow, but take a look at this 1 year high sitting at $400 right now, 67%, and after this one, it's probably going to be like 75 or something of that sort. So yeah, this company has been hammered completely. And I would really recommend that you watch this video in full because we're going to talk a lot about the pathology of the stock market based on this stock and see why these kinds of valuations are so wrong for these companies. I will explain the finer details, but yeah, I would really recommend that you watch this one fully. And remember that you know, if you are new around, you can become a subscriber and pretty much subscribe to our content here. I'm making all sorts of videos pretty much daily. And you can also leave a like in order to help our video grow and be suggested to more people. And thanks for that. Now, Snowflake, we can take a look at their earnings report. It plunged almost 30% on slowing revenue growth. It's what we're seeing here. Now it looks like it's a little bit better. It looks like it's getting a little bit better, but we'll see what's going to happen tomorrow. Now, the cloud software company expects 79 to 81% product revenue growth in the fiscal first quarter, and they lost 43 cents here. Revenue of 383 versus 372, which is better, of course. Now, revenue grew 101 year over year, and in the previous quarter, revenue growth reached 110. This is still, of course, massive growth here in terms of the company's growth, but the company reported a 132 million net loss. Now, it narrowed it from almost 199 million in the year earlier, is the thing. Adjusted gross margin of 70%. So yeah, the margins are discussed also as well here. And they are expecting a 65 to 67 product revenue growth percent in 2023. Okay, we took a look at what is happening with the stock price right now and what is happening with earnings. But let's take a look at the business now. Because this is very important. We are looking at a company that has been increasing its revenues, but it's not making profit, is what we deducted from the article that we checked earlier from the earnings report. Let's dive in and take a little bit of a closer look. The P ratio is negative again because the company hasn't been making money. This is a new IPO. As you will see here, we can take a look at the company profile, and you will see that this is a 2020 IPO. So this is a relatively new company in terms of it becoming public. Now, the price to free cash flow ratio at 500, this is massively high, as you can understand, means that the price of the stock is very high compared to the free cash flow that it generates. And take a look at this outstanding shares count. The company has been issuing shares like absolute maniacs here. They have been diluting investors tremendously, and if you bought back in 2021 or back in 2020 or whenever they had their IPO days, you have been massively diluted, and now your shares are less than 50% their worth of what you had back then, which is a big problem. And also, take a look at this free cash flow to total liabilities ratio, about 20 years of free cash flow to pay back all the total liabilities, and this is a company that is also not making money. This is extremely concerning to me because the company doesn't have enough free cash flow to pay back all the liabilities that they have. And that's very concerning for a company. Any company needs to generate free cash flow in order to be solvent, because the other path to continue operations is actually dilution or debt. There's no other way. I mean, if the company is not making money, how are they going to be funding their operations? There's two things. Either you issue shares and you dilute investors, or you get debt. Both situations are problematic. And in some situations, okay, the company may achieve profitability soon and start working towards that path. But the thing is, do you want to be overpaying for that to happen? It may be a better idea to actually wait for the company to achieve profitability before you enter the space, because otherwise you are prepaying massive amounts of money for what you are getting, is the thing, and you really want to be avoiding that as an investor, because investing is not only about buying great companies, it's about buying these companies at a very cheap price. That's how you make money. And you will see that the big problem, the net income growth is actually going down. This you hate to see, because in some situations you can be having companies that they're having negative net income, but it's going higher. So now we are looking at a company that is massively diluting investors, has quite some debt, it looks like, and their net income growth is going down. So when will this be positive? Because if this continues for a few more years, this is going to be very problematic for the company. Now sales are increasing, but net income going down. At some point you need to be seeing those sales converted to actual profit, because otherwise what's the business doing? Now the free cash flow has been growing, we'll see why, and the total equity has been growing, of course, because of this, because of outstanding shares being issued, in a factor of 100%, more than 100% here, 120, absolutely insane. And you can also see the price to sales ratio very, very high, super high here, like the price of the stock compared to the revenue. That's even the revenue, which is like their best thing, pretty much, their best metric. And it's still a 30 here, massively overpriced. Returns are, of course, negative. And let's examine the finer details in the financial statements here. This would be interesting to see what's happening. Now, revenue growth has obviously been their best thing, from 96 million to 1.2. This is great revenue growth. But the problem here is the net income is negative. And this is super problematic, of course, for a company, and it's even more problematic. Look at these losses every year. It's getting worse and worse. And even the EBITDA is actually getting worse, and very, very negative here. It's about the same as net income, really. So that's not great to see. This is a very, very bad sign for a company. They need to reach profitability soon. They seem to be going backwards. Now, if we take a look at their balance sheet here, they need to be funding themselves somehow, and their operations is not the way, as you can understand. So the way to actually fund themselves is by getting additional paid-in capital from shareholders, so in the billions, really, because they have been diluting them, like, as I mentioned earlier, like mad maniacs. And the total debt of the company has also been increasing. So both things are not looking great here. The equity has been increasing because of new shareholders and because of new extra debt. So not nice to see, not nice at all. And the net cash provided by operating activities is positive because of stock-based compensation. All these companies tend to pay their employees with non-cash items, which is like stock-based compensation. This gets adjusted in the operating activities cash flow, and this way you're looking at a positive number here. And a little bit of spending in investing, not too much here. But in terms of the financing, take a look at this value here, 4.7 billion in common stock issued over here. That's a lot of common stock. And the cash that they have is about $1 billion. Free cash flow that is marginally positive right now. And the company is non-profitable though, so this is problematic. It's mostly happening because of the adjustment for stock-based compensation. It's not because of profit, and that's a big problem. If we take a look at the stock evaluation tool, this is a company that is almost impossible to work around in terms of what to pay because it's massively negative. And if I were to sell a business to you, you came to me in order to buy my business, and then you ask me how much are you making every year, and I'm telling you that I'm losing $500,000. What's that company worth to you? I mean, you can potentially try to discover what the company is going to be growing at, what are the growth factors and all that, but there is always a lot of risk with these kinds of analysis. And also, how do you actually deduce what to pay? Because you would need to grow the company at a level that's going to be profitable, and that has a lot of potential headwinds, and it may actually never happen. Most companies that are not profitable remain not profitable for a long time or even go bust. You don't really want to be holding these companies unless there is a clear path to profitability, which I'm not really seeing here. It looks like the company is going backwards. They're actually losing more and more net income. I don't like to see that. This is not the right path here. This should be the opposite. It should start from minus 600 and grow down to 178, not the opposite side, the opposite way. I don't like what I'm seeing here. And so, of course, the margins are all negative. You cannot really use historical stuff. Let's just go with revenue growth that's going to be tremendous, 20, 30, and 40% for the next 5 years. And the company will finally become marginally profitable, 1, 3, and 5%. And it's going to translate to, let's just say, 90%, 100%, and 110% of free cash flow conversion in terms of a free cash flow margin, 13% for an annual return. Even these calculations will give us a price that is near the low tens, really, like the 3, 5, 7, 9, something of that sort. And again, these projections are also extremely confident. The company is nowhere near this one. And so, yeah, this kind of company is a big problem. I mean, for it's all about hype. There is nothing substantial here. This is not a company to invest in as a long-term shareholder. You can be really crushed here, and especially in this current market, it's a very bad idea to be buying these companies that are not profitable, and basically they are super overhyped and super overpriced for no real reason. And yeah, I would completely avoid this one for sure, no doubt about it. But do let me know what you think, guys, in the comments below. And remember to like and subscribe. You can always become a patron and get unlimited access to this tool, of course. All the links in the description box below. And in the meantime, take a look at this video that I made earlier. And I'm discussing Apple and what is the fair price to pay for the stock right now. Thank you for watching again. See you soon. Bye-bye.